And then we have, kind of going back a little bit to the foreclosure story, we still have a huge oversupply of vacant homes on the market nationally. There's about 1.75 million more vacant homes for sale and rent than underlying population fundamentals, which suggests that you should have. If you look at the rate of household formations, you look at the rate of obsolescence of homes, that should be, you know, according to our calculations, somewhere around 4.75 million. Right now it's at about 6.25 million, so there's a ton of vacant homes on the market. And again, this varies a lot depending on where you're talking about. That isn't so much the case here at all. I mean, we're lucky we don't have a big oversupply in the market, but there's still a lot of homes on the market, like I said, in places like Nevada and Arizona, California, and Florida. California is probably, of all the places that were sort of ground zero for the housing correction, California has made probably the most progress, and we're seeing the most kind of turnaround in the housing market. Florida is still in pretty bad shape, especially the condo market. So as long as we have this oversupply of homes in these markets, it means that there's no chance really of prices turning around anytime soon unless you draw down this excess inventory. So where's some of this, given all of this, where is some of the strength coming from? Well, one of the really encouraging things has been how quickly some of the global economies have turned around. We expected that a lot of, for instance, a lot of the European countries would lag us coming out of recession. A few have actually recovered before we did. A lot of these countries had stimulus packages of their own. Few quite so big as ours in terms of a percentage of GDP, but a lot of countries did do stimulus, and they're starting to recover. Especially in Europe, some countries have very interesting, creative ways of dealing with the labor market situation that we don't have here. That's helping them to keep unemployment lower than it is here, keeping more people employed, which obviously is good for economic growth. So we're actually starting to see international trade pick up, and that's, over the past couple of quarters, that's been a positive to GDP growth. Also, the dollar is quite weak right now, so not only do you have a recovery among a lot of our biggest trading partners, but you also have favorable trading terms for both them and us. Our exports are cheap. A lot of people are buying our exports, and we're not importing as much. That's mainly because we're in a very bad labor market situation, but also because their products are more expensive to us. So we're seeing some of these global economies picking up some of the slack. Going back to the job market, I mentioned this notion of a jobless recovery. As I mentioned, we think 2010 is going to be really weak. We think that the national job market, job declines will probably end in the second or the third quarter of next year. You're not going to see positive growth until the second half of next year. But it's going to kind of bounce along the bottom for a couple quarters. There's not going to be a lot of job growth going on. And until you get, most economists think probably about 125,000, at least on net, new jobs being created every month, you're not going to see the unemployment rate start coming down. We've revised our forecast in light of the unemployment rate that came out a couple of weeks ago. And we now think the unemployment rate nationally is going to peak probably around 10.7% on a quarterly basis. So that means in some months it may get as high as 11%, certainly, by the middle of next year. And then going forward, like I mentioned, you're going to have really strong job creation to bring that unemployment rate down. It's so high, and we've lost so many jobs, at this point almost 8 million, that we don't think we're going to get back down to a full employment level, meaning sort of a trend unemployment rate, until probably 2013 or 2014. So unemployment is going to be high for a long time. It's going to be coming down, but it's just the magnitude of jobs lost has been so great that it's going to take a while to work through that and add jobs at a fast enough pace to bring that down. A little more discouraging has been, you may know that every year the Bureau of Labor Statistics revises its employment numbers. They do this at the beginning of every year. And they just released a preliminary revision that shows that they're probably going to take another 875,000 jobs off of last year. That means they actually underestimated job losses by almost 1 million. So when all of that gets revised, we will have lost, 9.5, almost 10 million jobs just in this recession alone. Okay, so now I just want to take you through the timeline of how this is all going to play out. This starts in 09 Q1, so 3 quarters ago. Home sales have already bottomed out, it looks like, in most markets. Some markets are seeing increases, some markets are just sort of staying flat. Around here, it looks like home sales increased in the 2nd quarter and probably in a few months in the 3rd quarter. And again, a lot of that has to do with this first-time home buyer tax credit. And a lot of it is starter homes. The stock market appears to have troughed earlier this year. And as I mentioned, if you look at this, the TED spread, the measure of angst in the banking system, it looks like the banking system has stabilized for the most part. Housing starts, so home building has stopped falling, both nationally and in many areas of the country. I mean, home building was so low, I mean, in some places it just was non-existent, that there's actually pent-up demand for housing. There weren't homes even being built to keep up with underlying population growth. And the economic downturn ends. So the official end to the recession will probably be August or September when they go back and date it. As I mentioned, we don't think employment bottoms out until probably the 2nd quarter of next year nationally. And we don't think house prices stop falling, not to say that they'll start rising, but stop falling until the 2nd or the 3rd quarter of next year. This is nationally. In some localities, we have house prices falling well through 2011. If you look at places like Las Vegas or Miami or Orlando, we don't have house prices stabilizing until well into 2011. We think that foreclosures will peak in the middle of next year. Some of this depends on the administration's mortgage modification plan, which frankly hasn't really gone anywhere yet. It really hasn't been that successful. They were expecting to modify about 1 million loans, and they've only modified, I think it's like 4,000 loans so far. So not as successful as many people were hoping. And if you don't see a lot of those mortgages modified, there may be a risk that you actually have more foreclosures, and therefore that pushes back the recovery in house prices. And as I mentioned, we think the unemployment rate peaks probably in the 3rd quarter of next year, just shy of 11%. All of this means that don't expect the Federal Reserve to do anything anytime soon. At this point, we don't think they're going to start raising rates until probably early 2011. But again, depending on how the labor market shapes out, if things aren't really showing any improvement, it could be longer than that. We don't think house prices start rising nationally until early 2011. And then we think by that time, by the middle of 2011, after you've gone through the stimulus, after you have a recovery in the housing market, after unemployment has peaked, then the economy gets into its own self-sustaining expansion at that point. Meaning it doesn't need additional stimulus, it doesn't need additional fiscal or monetary help to keep going.